up, we will have our panel about Oracle Extractable Value, moderated by John Morrow from Gauntlet. So yeah, just give it a minute as our panelists take their seats on stage.
Hello. I'm John. I'm COO and co-founder at Gauntlet. We're a financial modeling platform for crypto. Today, on this panel, we're going to discuss Oracle Extractable Value. What is it? Why should you care? And what people are doing about it. First, instead of just introducing everyone myself, I'd like to give everyone on the panel a chance to do so themselves. So it'd be really great, just maybe we could go around from nearest to farthest here. What project you work on, what's your role there, and how do you guys use oracles?
Okay, hello everyone. I'm Sophie. I'm the data scientist from EigenPhi. And we are a data platform that observes on-chain liquidity, especially on the MEV activities. So OEV is definitely a topic that we're really interested in. And we also have a lot of research conducted on the long-tail OEV, like the Oracle tax. So I'm happy to be here to share our findings and research on the OEV.
Hi, I'm Jacob. And I had a background in MEV, and I've been contributing to API 3 DAO full-time for about a year and a half now, working on MEV and our OEV solution.
Hi, I'm Barney Mennerings, co-founder at Vega Protocol. We're a derivatives DEX, so obviously we use oracles to settle trades on the platform, so very important that the oracles are timely in providing the right prices that are needed. So obviously OEV is a big consideration, both in terms of the oracles you might use to create markets, but also in terms of design features we might include in the protocol to mitigate or deal with OEV.
Hi, my name is Philippe. I'm from Umbrella Network. We're an Oracle. We have several solutions to consume data on chain, and we're working on a new one. So we have kind of a data at scale solution, which harnesses Merkle tree technologies to kind of being able to provide a large amount of data on chain. We have the on-chain data solution, which we will be discussing in this panel. And we're working on an on-demand solution because we know that every single project has different needs in terms of data. And yeah, I'm head of partnerships, trying to work with projects, with layer ones, layer twos, to just expand the reach of our protocol.
Hi everybody, my name is Brenda and I'm the CEO and one of the co-founders of Tellor. We're also in Oracle and we provide different types of data on chain, and I'm super excited to be here and hear about what you guys actually need.
All right, thanks a lot. So I'm sure most people attending an event called the Blockchain Oracle Summit have at least heard of OEV or maybe could infer what it is, but I think that the best way to understand something is via examples. So I'd love to know what's your favorite or the most interesting example of OEV that you guys have found or know about, and and just to tell people a little bit more about what we're talking about here.
Yeah, so I think there's probably three main categories of OEV. You've got arbitrage, which is I think what someone was mentioning earlier. So that's just arbitraging a stale Oracle price that's not completely up to date with the real world price. You have liquidation, so that's obviously very different. It's actually kind of built into the protocols. It's necessary to prevent them from being insolvent. And then Oracle attacks, so any type of malicious behavior by the Oracle.
I think you pretty much covered it.
I think you covered a really good summary of the types. I think the one I find very interesting is, particularly when you're looking at, say, Ethereum-based chains or other general-purpose chains with gas fees, the baseline incentive is to provide as few updates as possible to an oracle. What you can end up with, due to, say, liquidations and the way those things get incentivized, is an incentive to provide more than the minimum number of updates. So, for example, with incentivizations where you can get paid to make a liquidation happen that should happen. Perhaps you have an oracle that price has to move, every 1% price move causes an oracle update, but actually someone's able to see that a liquidation would occur with a 0.2% price move, which is not going to necessarily trigger a required update, but you can get paid out for doing that. So you have an incentive kind of if the price moves in a direction that is hitting liquidations to update it more often, and then less often if it's not. And that, you know, can be argued about whether or not that's good for the overall price discovery and situation on chain. It's definitely good for making the liquidations happen, but it creates kind of new types of incentive, new types of performance, and things that are going to occur on chain which are perhaps different to the initial expectations of a protocol designer, and that's where you get funky behavior.
Yeah, but I think this is what you mentioned is always the cost of maintaining the current state of oracles. Just we set those deviation thresholds and the heartbeats and all of that just to minimize the cost. Updating an oracle on chain in a push manner is just far too. It's not even financially viable, not for the oracle, not for the for the end users that actually subsidize the oracle feeds. So yeah, it's about finding a new solution with post oracles to kind of optimize the outcome.
Okay, so yeah, about those kind of OEV tabs, EigenPhi's data has covered most of the, you mentioned about like arbitrage between the price of lending protocol and DEX, and also just doing simple liquidation, just repay the debt assets and get the collateral assets, and also the long tail MEV. So the data we only provided is including the first two, and those long tail MEV, which is like, this happened like non-frequently, right? It just happened like 1 year, this one time, and this kind of like very occasionally happened long-tail MEV. So it's including the research. But I was just wondering, do you guys want to know about the market size of the OEV? Like we have the data that has been collected and calculating on all the liquidations happened since May last year. It's a lunar crash when it happens. And that time, the OEV value is like extremely high. It's like $17 million extracted like for in May and in June last year because of the market. But I think I observed the liquidation activities as becoming quite stable recently. So because the market is quite stable and there's no large attacks happens or events happen. So it's only like for last month around $2 million, and last month in May it's like $2 million, and in June last month it's like some $1 million, and the activities also like 500 of liquidations counts happened like on chain. So because I'm very interested in all the MEV activities, and we're talking about in ETHCC is event on the MEV activities like the normal arbitrage and also like sandwich attacks. So the market is that liquidation takes like less than 10% of the total MEV market currently, and we also observe that the competition between the liquidators is still very intense. Like from the beginning, it's like they almost gave about 80% of their revenue to the block builders to include their transactions in the block. So that's some of our fundings, and I was just very curious about you guys you guys thinking on the market of the market size that I just shared about the liquidation.
Yeah, we're very interested in the data because obviously we're building out OEV solutions, so we're very thankful to people like EigenPhi for providing this for us. So yeah, liquidations are it's just a very sort of rare thing, and then it only happens at certain times in the market, but then when it does happen, the value can be pretty high. So you brought up May 2022, the Luna crash, I think that was, and then other than that, really the only significant liquidations we've seen in DeFi are May 2021, and then I think during the COVID crash in maybe March 2020, there was a lot on Maker during that time. So it's just very rare. It's sort of something that's inevitable to happen with markets, but it may take a year or two.
So, liquidations, a big part of any DeFi protocol or any DeFi protocol that uses collateral to back positions. What exactly constitutes the Oracle extractable value in a liquidation? So, for instance, if I were to bundle an Oracle update with a liquidation call to Aave or Compound or something like that, I'm kind of actually just doing the protocol a favor in some respects, right? Where I'm just helping them most accurately reflect prices in the protocol. Did I really extract value? How do you guys think about what value is really being extracted here?
So the way we define it is just the subset of MEV that is related to transactions that come either before or after an Oracle update. And that kind of encompasses arbitrage and liquidations, not necessarily the Oracle attacks, but the other two that it sort of encompasses.
Yeah, and I think one of the important things is that the OEV available, given for even on a given chain, say on Ethereum or wherever, but even then when you start looking at app chains and different chains, the OEV available depends heavily on the protocol's design and how it uses Oracle data. And to give you an example, if you have a protocol that has no real price determination that happens sort of natively and requires external price sources, but also external initiation of liquidation, so effectively you're outsourcing the liquidation function, then you have a very different maybe definition of OEV and amount of OEV available than if you have something like Vega, which we work on, where we have an on-chain order book with sort of circuit breakers as well to manage volatility, but also where liquidations kind of happen atomically. So, effectively on something like Vega, what happens is the price determination happens based on the trading activity. If you're talking about something like perps, the Oracle is used to kind of settle the prices at a regular interval, so the Oracle has an input there, but actually what's happening is the Oracle is part of the input to price determination, and it's the system on chain is doing all of the liquidations regardless of Oracle. So in that case, liquidations will be occurring if traders move the price by making trades, as well as if the Oracle tells you the price has moved. Whereas on some protocols, you require the external input and the Oracle before the liquidation occurs. And so, one of the ways that I think about this, and I have the same sort of opinion of MEV, is there's always going to be some OEV, there's always going to be some MEV, but designing your protocol or even like the base infrastructure chain that you're working on in such a way that it allows for excessive amounts of that and creates kind of incentives for an ecosystem of people kind of trading this sort of value extraction from the protocol. And that's kind of what we mean by extractable value, right? You've got a protocol that has natural users who are buying and selling liquidity, buying and selling the underlying or the derivative or whatever. They're the natural users. And when you have a sort of parasitic user who can extract value from that natural ecosystem by making something happen, either because it's badly designed or because it needs that forcing function to happen, that's kind of your extractable value. And I think designing the protocol to minimize that and trying to have the smallest amount of that value sucked out of the ecosystem is one of the most important things. So that's how we think about defining it, and we also think about trying to minimize it rather than trying to legitimize it.
So, kind of moving on here, I think then, we've talked about sort of how this value can be extracted, but what do you think the biggest threat that OEV poses today? Is it just around sort of basically rent seeking or people joining the market and not providing value to natural users, or does it affect security, stability, decentralization?
Well, I think the threats we are facing for OEV is because the Oracle is like bridge to transfer the off-chain information to on-chain, and it's just like how do you make sure the information you get from off-chain is reliable, and all the DeFi system is based on the oracles. So if there's like manipulation on the oracle's price, and they will just put the whole the system that relies on this oracle in danger. So there's many attacks has happened. We have I just want to share an example that we have found for oracle attacks on the Abracadabra this protocol. So this attacker was borrows the assets in a rate, and then wait for the rate to be updated, and then just liquidate its position by then, just using this kind of steps, doing this kind of attack. But the thing is, at that time, the price of this collateral just dropped, decline very dramatically at that time, 15%, or in seconds, just drop very quickly. But the price in the protocol, it's just saved the oracle's price. It didn't get updated in time. and that's where the attacker could extract so much value from the protocol and causing loss of the users. So this kind of things we have observed happened a lot last year, and I think this because some delays on the oracles could causing a lot of troubles and put the users' assets and also the protocols in danger. And I think, I think this is a threat that OEV is facing now. Is kind of how to design a oracle or the protocol to avoid this kind of long tail OEV.
Yeah, no, I think the Oracle resilience is key there, whether it's by design or just malicious input of data that is causing this this situation that you say, and then just creating this OEV. Maybe I actually like what API 3 came up with this. Solution where someone who sees that an update is needed, create a market for it, so that someone could actually go and update the price as often as possible to create that, and this would minimize the cost on the end user value, but create an opportunity for someone else to come in and extract a bit of value, but do some good to the overall protocol. But yeah, the security aspect of maybe not even updating the price, but not updating the price for a while, whether it's a DDoS attack on the node that's going to update the price or whatever. This is the biggest security issue and threat in this area.
Yeah, I think sort of building on that, I think one of the key things with a lot of oracles is what you might call economic security. So the idea that people are either incentivized to be honest, or even at the base layer, you're actually taking some data from another market, and so that can be manipulated at a cost. Particularly when you have an oracle that's updated very rarely, if the OEV available on that protocol starts to be large enough that it can fund breaking the economic security of the oracle or manipulating the underlying market. And bear in mind, in some cases you're talking about derivatives where, at least in traditional markets, you see hundreds of times the notion of the derivative than the underlying. So you could end up in a situation where your oracle is based on a Uniswap price. If the OEV was near to the market cap of the underlying instrument, but the derivatives market is huge, the OEV can be very large, and you start even manipulating prices. So I think, to me, the biggest threat is how do you maintain economic security in the face of OEV? And one of the reasons is to try and minimize the available OEV, or to maximize the amount of time you have to keep that up for. Because if you only update the oracle once a day, or when the price moves 5%, then you manipulate the market once, and now you can extract, and you can be far away from where you should be for a long period of time, and that's where you start to get real problems.
I mean, if there's that incentive will always be there. If there is a greater gain from an attack, that's always going to be there. So that's something that I think it's not just OEV, but just in general, protocols need to take into consideration, especially because a lot of protocols, I feel they don't look at the Oracle implementation until the end. And some, when you're talking about this latency or this delay of getting this information updated, it's how is a protocol handling actually paying for it? I mean, there's gas cost associated with every update. So when things move, when they have a heartbeat, when they, even if they implement something like with API, you're not really shifting or fixing it. You're just shifting who gets the benefit. And I think in DeFi, just in the traditional system like here, we're going to end up in a space where we're going to have to admit that the biggest players and the most profitable ones will be those that are the most technical ones. And it's very hard to really fight that, because if the gain is there and available, the most technical people are going to be able to exploit it no matter how you go about it. You just make it a little bit harder. And then we have to start thinking then, who are our ultimate goal as our users? Because now, even with the API 3 solution, you're looking at hopefully driving the profit to zero with this open market and the auction, and then sort of giving back this part of that profit to the dApp. But should the dApp be profiting out of OEV? I feel like there's this weird or incentive that could also be dangerous. But, yeah, sorry.
Yeah, so to sort of clarify, API 3, the ethos with our solution is, like everyone's been saying, to first minimize any that is available, and then we sort of believe there is an inevitable OEV that you just cannot minimize. And so from there, we want to be able to capture it and give it back to the dApp or its users. So we have kind of remained unopinionated about what should happen with the OEV. We allow it to go back to the dApp, or the dApp can choose to distribute it to, say, like the user that was liquidated, or maybe the LP pool that was arbitraged. So personally, I believe that it should go back to the users, because you're right, like there is a weird incentive there if the dApp is profiting off of it. And I think going back to the users is just inevitable, because what we want to do in DeFi is provide best execution. We don't want to be extracting big fees from users.
Yeah, and you don't want, I mean, I would think that the arbitrage, or whoever got arbitraged, it could have been them, right? So because everything is anonymous, so I feel like I definitely would go with the users. But yeah, no.
Yeah, that's sort of, and going back to the original question, sort of aside from Oracle attacks, the biggest problem with OEV is probably this arbitrage, which, as we've kind of mentioned, is just impossible to fix with a push Oracle. Even if you push the price every single block, there will naturally be some delay between the data and, say, the Binance price. So, and that causes big issues for perp dApps like Synthetics or GMX. That's why they had to raise fees to 10 bips, where it's like 2 bips on Binance. So that's probably the biggest problem that OEV has been causing to DeFi, I think.
Yeah, I think that's a really good point, but I think equally you can do more to minimize that. Like, for instance, on Vega, because we're an app chain that's designed entirely for trading, we have a sort of sub 1 second block time, and we also have no fee to send the Oracle update. So from the side of our chain, you can update once or even multiple times in a block with the latest information. Now, that doesn't get rid of the delay. There's a delay because of the latency of a block. There's a delay, as there always is in any price feed. But minimizing those things, reducing them, and also it's a very strange incentive having fees to push data you need. It's one of the big problems with general purpose chains for trading is, if you're a centralized platform, what you want to do is attract people to place limit orders and give pricing information, and attract people to provide up-to-date market data. If you're a decentralized platform, you kind of go, hey, we don't want that. You have to pay to provide it to us. And so I think one of the reasons I'm very bullish on app chains, other than the fact that we built one, is that I think being able to control the fees in a different way and actually say, well, the trading activity generates fees, and then there are certain things we actually either want to pay for or don't want to disincentivize and want to make free, enables maybe improving some of these things in terms of the frequency of updates from oracles, for instance.
So I forget who it was, but someone mentioned like push-style Oracle updates. I think that, you know, to not play any favorites, I'll use 2 examples from oracles not represented in this panel. But I think that, like, you know, you see the Chainlink style stake and slash oracles that provide some security there, as well as things like Uniswap, where you can derive price information from the pools. How do you think those 2 solutions, you know, affect OEV? And are there other solutions that maybe take a little bit from both, or new altogether, that might provide better solutions for, you know, preventing undue value extraction from rent-seeking market participants?
So I think, I mean, you mentioned TWAPs. They're sort of, in terms of arbitrage, that is sort of the opposite way you want to go, because they're naturally delayed from the real price. But I guess the most exciting thing happening now are pool-based oracles, allowing you to sort of, the oracle produces the prices off-chain or on some other venue, and then anyone can take that price and push it on. So what dApps are doing, like Synthetics and GMX, so they're moving towards a design where every time you want to make a trade, you have to push a new price with it to sort of guarantee that you're getting the least stale prices possible. And even what Synthetics have done is implement a delay. So if you want to make a trade, then you make an order for it on chain, and then that order cannot be filled for 4 seconds. And it's getting filled with an Oracle timestamp from 4 seconds in the future of when you made your trade. So it's actually impossible to know for sure what price you're going to be getting executed at, which makes arbitrage basically impossible. And there's another cool thing you can do is if you, so the delay is 4 seconds, for example, and they set that because the time that their Oracle lags the real-world Binance price, which is just the time that it takes the Oracle to get the prices from Binance, come to consensus, and produce it so it can be consumed, is about 2 to 4 seconds. So if you're getting filled at a trade 4 seconds in the future of your order, that was actually probably the real-world Binance price at the time when you placed your order. So effectively creating no delay between the Oracle and the user's trade, ideally.
I think it's interesting when people talk about the Binance prices being real, because I don't know, I've never traded on Binance. I don't think I'm even legally allowed to as a U.S. resident. And I know for many of the assets I trade, which are low liquidity assets, maybe some people call them shitcoins. I don't know. I won't judge. I kind of feel like the primary market is often something like Uniswap. So like epistemologically, it's hard for me to tell. People say, like, oh, the real price is on centralized exchanges. And I'm like, well, these assets really aren't on centralized exchanges at all. For low liquidity assets, how does that affect OEV solutions?
I mean, that's something I sort of agree on that point there. I mean, I think, and also the other side of it is simply to try and build decentralized systems that then require Binance to be the real price and to continue to be the real price is just pushing your Oracle problem to some other centralized party which you may not choose to trust forever. So one of the things I think is good about having something like Uniswap, even if maybe you're taking extra delay, but you're also in a situation where there is a huge amount of capital incentivized to arbitrage to the fair value price of a thing on Uniswap, not because they have an incentive to get your Oracle price right, but because if the price on Uniswap is wrong, they can make money. And so fundamentally having open source rules, which everyone can trade on, that are on chain, everyone can see the data, and saying what we actually want to do is increase the speed and decrease of Uniswap doing price formation, increase the quality of that price formation, and decrease the speed and latency between that price being formed on Uniswap and getting to the protocol that needs an Oracle. To me, you can't get much better if you have a primary market that you can create that's open and transparent. And I think attempting to, the other is also kind of like a bridge risk, right? So if you have, two chains that can talk to each other using some kind of protocol and move data directly, you have better security than if you have an extra thing in the middle with a bridge and some validators who you also have to pay. And the problem with adding Oracle protocols anywhere is you've now got something that forms the price over there, you've got something that's consuming it over here, and they all need to be incentivized. And you've got something in the middle, which is an Oracle, and now you've got to find the money to incentivize that. So you're either making it less competitive, less better execution, or you're creating an incentive for people to sort of attack and find OEV. And so that's my view, is like really finding the primary source of data in the primary market and reducing latency and increasing quality of that is going to be better long term.
There's always trade-offs on how you choose your data, but if you're going to choose something with really low liquidity, you have to admit that you're taking a higher risk. So that just comes with the territory. And it's not necessarily, we launched a token, when with Tellor, but like when you first bootstrap it, it's probably not worth much. Just make sure you're not securing billions of dollars with it. And maybe you can bootstrap it with time and find the liquidity and be able to form the market.
Yeah, I think there is a separate point which is outside the scope of oracles, which is to say, if you have very low liquidity and low trading volume, the price in the market may not represent the best view of the fair value of something. You have like the AIM market in London where some of the small stocks on there trade like 3 times a week. And if it last traded 2 days ago, is it really the case that that price is the fair value of that thing? No, if you were going to buy it, you would do external research. And so at that point, you're more into like, how do you incentivize someone to actually determine the fair value if there isn't a liquid market? And that is perhaps a different question than how do you take some piece of data from the real world and get it into a protocol, which is the Oracle problem.
Determining robustness of your data has to be part of it. And definitely, like if there is no market, it's going to be very, very difficult to do price discovery.
Yes, for those low liquidity assets, like pricing them could, the price of them could, the attackers could manipulate those kind of low liquidity assets, right? There's a lot of attacks happened by manipulating the Oracle's low liquidity assets, like flowing in the market, and then gain a lot of value from it. So the pricing of the low liquidity assets is very important. But currently, I think the Oracle's price of this kind of assets is still based on like the historical price, it's a scalar data, and it's now considering about like how the liquidity is flowing in the market. That's why I think more parameters should be passed into like pricing these kind of assets. Like you put like price impact, those kind of parameters to indicate how much liquidity has been flowing in the market. If it's like very low liquidity, it's like a high risk of like trading this kind of assets, especially like depositing and lending and borrowing this kind of assets. So it's just like some like indicators should warn the users or warn everyone.
I think that's a really good point, because ultimately, you know, it depends what you do or what you define as what your purpose as an oracle is. And yes, you're supposed to be secure, but in essence, you are just transferring data. You have, as an oracle, I think it's super important to talk to our users and talk about the robustness of the data that they need and have a proper definition of what they actually need. You can't just be using somebody else's proper definition for a shitcoin, you know. It's like, you're gonna be like, oh, okay, great, I'm just gonna take it because they said this is how it's supposed to be done. You're taking somebody else's use case that may be perfectly great for them to use, but applying it to your case, it's probably not the best thing to do. So no matter who you're using as an oracle, you should definitely have that conversation as to what should be the price that they should be providing.
You know, I think one thing too that protocols that rely on oracles have to do is acknowledge just some of the uncertainty there, and also just some of the risks. So, for instance, like at Gauntlet, we set caps across our customers' protocols, like an OEV and Compound. There can only be so much collateral of a certain type deposited, or so much of an asset borrowed, and you know that actually allows you to limit some of the issues that Barney mentioned, where you might be relying on a very small underlying market of trading to support, you know, a really large quantity of value. And if you have, you know, hundreds of millions of dollars of some asset in a lending protocol, and you get a bunch of liquidations, there's much less than that in actual real liquidity in this, you know, on chain. Then you're going to have some very undesirable outcomes. But so now kind of let's get onto some of the fun stuff here. In the future, you know, I think that OEV, it's sort of an emerging field of study in the industry. I would love to know, you know, what do we think the trends are for OEV going forward? How do we think the industry is going to look with respect to OEV in, say, maybe 5 years?
Well, I think with the regulation, like all the efforts made, like of all the security settings of the oracle's price, price definitions, all the efforts made, those long tail MEV should be like eliminated a lot, like for the OEV market, and the regular liquidation will be more standardized, because I think currently the lending and borrowing market is lack of standardization, and which leads to it's hard working for the protocols and also for organizations to develop any strategies to protect the users. It's very hard because, you know, lack of the standardization, and so things could be done like, I think the first thing I could think of is like real-time risk management based on the like the on-chain liquidity data to help the user to manage any risks. And the second is the Ethereum is like lack of liquidation layer. So everything of all the liquidations happened is out of protocols, controlled by protocols and oracles. So I think with all the regulations, like in the future happens, we're expecting more of standardized liquidation, the OEV market, and with less attacks happen for the on oracle attacks, which will lead to, you know, less loss from by the users, and, you know, a much healthier market.
Yeah, I mean, I have a feeling it'll be quite different MEV. And the reason I say that is with MEV, what you have is most of the value on one chain, Ethereum, and that chain moving relatively slowly in terms of how like the underlying infrastructure changes. So you have the conditions for some group of people to get deeply into like how to extract MEV and how to build an ecosystem. If you look at OEV, you have an ecosystem of hundreds of Oracle providers and also hundreds of protocols they're going into. And the OEV solution for each combination of like this Oracle and this protocol, like what can you do with Oracle data in this protocol to extract value, and then what does that Oracle, how could it be exploited, or how could it take advantage of that, or how could some other actor take advantage of that is different. So you're sort of in this situation where if I pick a pair that's very common in Oracle, like, I don't know, Chainlink going into Aave or something, I don't know, and something like that, and say I could exploit this for this much, if people see that and don't like the outcome, maybe they just change the Oracle or combine two Oracles together or find a way to fix that. So I sort of feel like what you will end up with is Oracles may be looking to use OEV as a way to get paid, because Oracle, sometimes it's difficult actually to figure out how Oracles get paid themselves. And then sort of more like opportunistic attacks where kind of like maybe not exactly black hat attacks, but where someone sees a protocol with a large amount of stuff going on, a large amount of liquidations that could be happening or whatever, and effectively they like exploit or close to exploit for sort of individual circumstances where they see big amounts available. But in terms of like a big MEV style ecosystem for continuously exploiting, I think that's probably much less likely to emerge, in my view.
I do think Oracle latency arbitrage will be a thing of the past in 5 years, and it's going to zero because of sort of the pull Oracle implementations I was getting at and things that you're doing at Vega Protocol. I think that will no longer be an issue soon, but I'll sort of take the opposite side of your view regarding OEV compared to MEV. I think we know liquidations are here to stay, and I don't think there's a fundamental difference between how liquidations occur and how sort of the MEV like sandwiches or backruns on an AMM will occur. The way MEV is trending is order flow auctions, which instead of what you'll probably be familiar with is priority gas auctions, where searchers are bidding to get the right ordering in the block, and then the value goes to the validators. And the new trend is making the user, who's maybe getting sandwiched or backrun, the auctioneer instead of the validators, and giving that value back to them. And I think fundamentally, there's no reason why that can't be done with liquidations as well. And I think it's sort of inevitable that all liquidations in the future will go through some type of auction with the user as the host, so they get their value back.
I mean, I agree with you. The future, or I feel like DeFi protocols are moving, thinking about how to get away from push oracles. It's a natural evolution. Right now we have this industry standard. Everyone's using it, and everyone's piggybacking on Chainlink's oracle feeds for the top 20 assets, because most of them don't pay for it and it's free, so it's always cost optimization there. But this pull oracle is what is gonna make it, as you explained earlier, closer to the truth and minimize the OEV, and probably maybe it will be just a matter of discussing this for the next few years, but that might disappear at some point.
Yeah, I mean, I think the ideal version of a pull oracle is in fact something a bit like an order book, right? So like if you're actually liquidating based on a market price, you ideally want to do what centralized exchanges do, which is actually say the market is going to tell us what the price has moved by placing orders and by moving the price. And so you can end up in a situation where you're much less dependent on oracles for liquidations. And I would imagine that in 5 years' time or 3 years' time or something, like a very small percentage of liquidations will be driven by oracle action as opposed to other participant action on protocols.
So I think you just painted a really interesting picture of what things are going to look like going forward, and some of the trade-offs there. I think a couple of the things people have been talking about a lot over the past week are things like restaking, as well as privacy-preserving features like snarks and starks. Will things like new types of staking systems or ways to leverage existing security towards new problems like eigenlayer style restaking? Will this, or things like ZK snarks, will this affect the future in some way, or are there other technologies that you guys see emerging that might change this landscape?
I think restaking is a sort of cool thing, and it can probably be applied to every sort of DeFi protocol to maybe improve it. So I think there will be some Oracle implementations of restaking to improve security, but it's so early. It's very unclear what the outcomes will be. I don't have any type of view on it yet.
Yeah, I think sort of similarly, like there's a lot of stuff around sort of ZK, layer 2s. There's a lot of stuff going on which I think should, as that technology permeates into the design of Oracle protocols, you sort of started with extremely naive protocols that will be quite easy to disrupt unless they have a huge amount of economic security, which is perhaps very unlikely to be achieved. And over time, we've sort of improved on that. So I think, I guess I see the direction of travel as this kind of technology, restaking, et cetera, helping to improve the economic security of protocols, helping to make manipulation more difficult, helping to make it more expensive or last for a shorter period of time. I think I see that happening, but kind of similar to that point, I think that the exact way that happens and how far it will go is not clear yet.
All right, well, I think now is as good a time as any to maybe open up the floor to questions.